Hey folks, David Frost, MyStrategicForecast.com. You're here for another episode of Common Sense Technical Analysis. Today is Wednesday, July 2nd, 2014. You're looking at a chart of the SPY, mirror image of the S&P 500. More of the same today. The market's floating around. I said the market would just float up into the holiday weekend, and here we go. We're floating up into the holiday weekend. The one exception may be you might get some, there's payroll numbers tomorrow. You might get some whipsaw in the morning, but that shouldn't last more than an hour, and probably not even, 10, 15 tops for the most part. So you may get some back and forth action depending on what the phony payroll number says. And here's the deal with that, folks. These are government numbers, and what happens is the government people, or the people in the government, the Department of Labor and all that stuff, they pretend that they know what the number is. And then the people on CNBC in the morning that talk about the number pretend that the government knows what it is, and they pretend it's a real number, and they pretend it matters. So that's kind of what goes on there. So it lasts a few minutes, and then it's back to business, and the market closes. The stock market closes at 1 o'clock tomorrow. The bond market closes at 2 o'clock tomorrow. So after the phony payroll number, you can expect the market to just float sideways to probably slightly higher with no volume whatsoever. In fact, today, I think this was the lightest volume day of the year. On the what do we have on the? You know what? This is a weekly chart, folks. I'm sorry. Let me go to the daily, and it was still light volume. You had 52 million shares, and that's through 4:15 this afternoon. Tomorrow you're going to have less. So market closes 3 hours early, and there's nobody there, so you're going to have less volume. So don't expect anything to happen tomorrow. So let's leave the SPY alone for now, and let's move over to, you know what? Before I do, I want to make mention that for members, I was looking at a couple of swing trades today, and I didn't issue them because they really didn't get to my desired target price that I wanted to buy them at. And so maybe tomorrow, but if not, I'm going to err on the side of caution, and we'll certainly have some next week. And there's plenty of time left for some long swing trades before the big cycle date comes later in July. So that being said, I just wanted to make mention that while it's been kind of quiet, it doesn't make sense to force any trades. We let the market tell us what to do. We don't force our will on the market, and we don't force our will into a trade. So the only real material thing that happened today was the interest rates. The 10-year ticked up 6.5 basis points today, and we're coming, and I said we'd go back up to this 267 area, 266, 267, 265. I think we're going to get there maybe even tomorrow. It really depends on what the payroll number says and how the market reacts to it. But, I thought we were oversold here. I said we should see an up move, and you probably see a pause up here. There's a lot of resistance. However, when you look at the longer term of interest rates, the weekly chart, I think this bottomed at the 200 period moving average, and I think that there's a lot higher prices to come. There'll be a lot of support also, or resistance in here, but we're going to move higher, and we're going to get back up to 3%, and I believe we're going to get back up there this year. And if you think about it, two things can happen with interest rates. The market goes down for some reason will be determined later, and people rush to treasury bonds and push the yields lower. That's one scenario that's likely to happen. The other scenario is rates are going up for their own reason, and the market reacts negatively to higher rates, which can choke the economy. Higher rates means less borrowing. It means higher interest cost, which means higher cost of borrowing. So corporations have to spend more money to borrow, and if they have to spend more money to borrow, they're earning less money, and that puts downward pressure on earnings. So if we have higher interest rates, it makes sense that the market would go down. And that's needless to say that the whole country's addicted to low interest rates to begin with. So once interest rates start to creep higher, we start making excuses why it's a good thing and the market could stay up. But when people finally realize that the economy is going to be negatively impacted by higher interest rates, then the market typically goes down, and that's another likely scenario. So we'll see how it plays out, and we'll play it off the charts, not the news. But I'm just telling you what to expect to hear in the news and what some of the reasons may be later on. But let's even look at a longer term chart of interest rates, and what you'll see here is you'll see a very, very bullish pattern developing. You had a bottoming out here of the 10-year, okay? You had an up move. You had sideways consolidation since really last summer, so you've got a year of sideways consolidation. And what's typically the next move? You're above the 50-day moving average, or pardon me, 50-month moving average, and the 20-month or 20-period moving average is coming in and crossing upward, which means, it doesn't have to mean, but it certainly signifies to me anyway, that there's higher prices or higher yields ahead. So where's the next major level of resistance? Really, it's at 355 on a monthly basis. That's a long way on the 10-year from 260, 265. That's going to be a big deal. That's 25% up move in interest rates. That'll choke the economy, whether anyone wants to believe it or not. The last thing I want to look at tonight is GDX. Not much happened in the gold market today, but GDX, not that GDX went up a lot. Let's go back to the daily chart. Well, that's weekly. But what I told you folks that I was going to do some more work in GDX, and I've done that. And I want to do it before your eyes, because when you look, this is bullish also. Big up move, sideways consolidation. I think we get another up move, and this is just going to be a way station here. I think we go much higher. But let me show you why. Because, and I alluded to this the other day in the video, but here what we have, I pretty much confirmed that this is the case. So I'm going to try and do this quickly before your eyes. I'm not the best artist on these charts, but let me just indulge me for a second, because there's some method to the madness. So these aren't going to be exact because I'm trying to do it fast for you, but basically you have a head and shoulders pattern developing here, okay? So here is a left shoulder. Here is a head, okay, and these don't always work out, but guess what? When they do, they work precisely to the number most of the time, okay? So, sorry it's in red. I wish it was in a different color, but nevertheless, hopefully you can see that. So here's a left shoulder, a head, and a right shoulder, and this is basically, I should have said, it's an inverse head and shoulders. So what happens is, if you break above here, okay, let's move the chart over. Well, I don't want that. Sorry, folks, I told you about the drawing. Move the line. Okay, so let's move the chart over. So if you can envision this on a weekly basis breaking out above, what you'll typically see is you'll break out above, you'll retrace back down to the line, and then you'll shoot higher. And you may just shoot higher, but we're going to take a trade here once we confirm above this line. And what happens is, if you simply take a measurement, and here, let's do it again, real time before your eyes. Let's take a measurement from the neckline to the top of the head, okay? And again, it's close. It's not exactly precise, but it's close. Now, if I can copy this, I don't think I have copy on this chart. You know what? Let me just do it by numbers. I was going to fold this up, but I can't seem to do it with this this program. Anyway, so here it is. So you have 20 and change. Let's call it 20 and a quarter up to 29 and a quarter. 9 points. So you fold this over, 29 and a quarter up 9 points is 38 and a quarter. So 38 and a quarter is your upside target. So where does that bring you? It brings you to this major level of resistance here. Why? Because the market came down, consolidated sideways for a few weeks, several weeks. Okay, 1, 2, 3, 4, 5 weeks, and then it started down. So there was a lot of people that got caught thinking that the market bottomed here and it was going to start back up. So these people here that bought in this area, and they took it on the chin all the way down, okay? They're still holding, all right? So guess what? When we get back up to 38, here's your sellers. These are a lot of sellers going to be in here when we get here. So that'll be an area where we'll take the trade off the table, and we'll see where the pattern goes from there after the fact. So that's where I'm looking at on GDX. I think it's a good I think it's going to be a great trade for us. I think it's going to provide a lot of gains I believe that the gold market, and I think GDX will follow, should have one more solid bottom like I've been telling you, and I think it's coming up within a few weeks. I'll keep you in the loop, looking for a trade in GDX and also some gold mining stocks that I'll talk about another time. For now, we're going to leave it here. David Frost, MyStrategicForecast.com. Thanks for tuning in, folks. Common sense technical analysis.